Hey, it's Phil Wade from Dalton Wade Real Estate Group. Good morning. We're here today with Lisa, Lynn eating a bagel, and Lenny Moniz from Mortgage Equity Partners. Today we have a special guest speaker, Lenny, and Lenny's going to chat. And he actually brought food. Show the food, Lisa. So everybody's missing out who's not here physically. So hopefully a bunch of people are watching on Periscope. But Lenny's going to talk about really two things to help you in terms of kind of informing your buyer clients. One is going to be that sometimes most consumers, buyers, they focus on the interest rate, and oftentimes they may look like they're getting a lower rate, but the fees that they're actually paying take that rate and actually make it more expensive. And then he's going to touch on some do's and don'ts for buyers as they're going through kind of the loan process or right up to it, so that you can kind of mention these things to your clients. So without further ado, we'll turn it over to Lenny.
Hello, everyone. Thanks for having me. Thanks, Phil, for having me here today. The first thing I'd actually like to talk about is our company. Our company is a lender. We're based out of Linfield, Massachusetts, and we have some branches throughout the East Coast. We deal with all residential types, with FHA, conventional, USDA, and VA loans. We like to think we use common sense, and I think we do in the underwriting process, which actually helps out in the realtor relationships too. But the one thing I wanted to talk about that Phil was just discussing was a lot of people think that they come to me and they say, I want the best rate, or I want the lowest fees, the lowest closing costs, and I get that, you want that, but there's really a loan product or a program that a lot of people miss out on because they think that the best rate or the lowest fees is the best product, and it's not always the case. And before we came on here, we actually talked about this, and we had a little debate about is it easy is it conventional products? You're always told that if you can go conventional, you go conventional. Well, if the property doesn't meet FHA or other products, then yes, that would be correct. But I'll use an example here. When you have a lower score borrower, 620 to 640, the conventional product has a higher mortgage insurance premium than FHA does, and it may be harder to qualify for that product, and the rate is actually sometimes 1% higher. So in that case, that borrower may make, as long as the property qualifies, may make more sense to go FHA. The overall debt that they pay on that house will be less than that conventional. Or if you're in a USDA area, 100% financing, a lower mortgage insurance premium, that may be a better option for your borrower.
So Lenny, can you get somebody done with a 620 credit score for FHA?
Yes, we actually go as low as 580, but 600 is a good number to go off. 580, they have to meet certain requirements, and it's a case by case on that.
So just for the agents and everybody out there, sometimes you may, or your client may have gone to like TD Bank or Bank of America. So when they're going FHA, certain lenders have what are called overlays. So TD Bank won't do anybody FHA unless they're 640 or above. So a lot of the big banks have that. So sometimes they can still qualify and get a pre-approval. They just need to speak to Lenny or a mortgage company that actually has slightly lower credit scores. If you go on the FHA website, I believe it's 580, and then they're going to pay a slightly higher rate because of their lower credit score, but they can still purchase a home.
Yeah, usually, thanks, Phil. Usually after 640, there's really no hit to the interest rate. On FHA, it's usually when it's lower, whereas on a conventional loan, every 20 points, meaning 640 to 660, those tiers are 660 to 680, there'll be a hit to the interest rate. So with that lower score, we'll have that higher interest rate, and if you don't put 20% down, you're going to be paying that higher mortgage insurance premium. And I do want to touch a little bit on when I'm talking about the products. Even in the conventional product, there's a lot of mortgage insurance option, whether you're paying up front, whether you're paying a monthly, and talking to your borrower and really seeing what their plan is with that home, whether it's a 4-year, 5-year plan or a long-term plan, you may select a better mortgage insurance option for them, which the overall payments would be probably less for them, or more equity in the home when they do sell the home. But as far as overlays,
do they still have lender paid?
Yes, they do. And an example of whether I'd put somebody on a lender paid or a monthly, if they come to me and said, I may leave in 3 years, because they've shown a history of leaving, lender paid may be the better option. They'll pay the higher rate for just a short time, and because the lender paid just means a higher interest rate.
Yeah, the lender has built the mortgage insurance into the rate, so they're not actually, there's not a separate charge. So they either get a lower rate and then pay the mortgage insurance, or when it's called lender paid, it's built into their interest rate.
That is correct. But as far as overlays, we don't have any overlays. We follow the agency guidelines. So if it's FHA, we follow what FHA actually does. If it's conventional, we follow the Fannie and Freddie Mac guidelines. If it's USDA, it's USDA and VA, the same thing. So as far as the overlay part of it, we really don't. We don't have anything. And I know some of the lenders and usually the retail channels out there, they have a bunch of overlays. They're there to get the deposits, not really give you loans.
Right. So I guess again the point is, so if you have somebody that's, I think if they're 640 and above, they're probably good to get pre-approved anywhere. But if they're slightly lower, you might have them call Lenny because they may have difficulty at Bank America, TD Bank, Wells Fargo, some of the bigger banks. So
yeah, I like those banks actually because it creates a few transactions every month after they've been underwritten. So yes.
And plus, again, and as we all know, the larger banks sometimes they're just not as responsive as Lenny is going to be for your client. So,
and I can explain why. I mean, it's just the process. The process at the retail channel or the bigger banks is that they have 5 or 6 people throughout that transaction. And the person that actually takes that loan application is just doing one small part. It's getting the information from that borrower, and then it gets moved on to the next step. Whereas the loan originators at a smaller company, they take responsibility on that pre-approval. They've looked at income, they've looked at assets, they looked at the main things on a true qualification. We can't call after TRID. There's no more pre-approvals. The underwriter has to approve a file, so it's a pre-qualification. So when you qualify that borrower, you got to look at all that stuff, because if not, that paper that pre-approval means nothing, So yeah, that's one of the benefits of a smaller mortgage company like ours, like Mortgage Equity Partners. We give you that from the beginning. So when you're out there shopping with your borrowers, they're qualified.
All right, so maybe we can talk a little bit now about the do's and the don'ts for your clients.
There's a lot more don'ts than do's, right? You wouldn't believe. I mean, as far as people buying homes, and I can't believe how many people go on vacation during the loan process or right before they're closing. But a few of the don'ts out there are: don't do anything with credit. Don't buy anything. Don't pay any collections off. Don't go get the furniture. Don't go finance any furniture on there. I got a list here of some other ones here so I don't miss anything out. Yeah, don't co-sign for anyone. And this is probably the most important thing here. When we document the cash to close, so when they give you the escrow deposit or the EMD or the earnest money deposit, it's very crucial that the loan officer knows where that money's coming from, because we got to document where those funds came from. So don't transfer money between accounts during the loan process. Don't take cash from anyone and deposit in there, because you're going to have to document that. And that's one of the most frustrating things in the mortgage process for everyone, not just us, the borrowers. They actually created that issue by depositing money. Talk to your loan officer, make sure you have enough funds to close, and don't make any large deposits in those accounts. If that was not done, if everybody just left their accounts alone, it would probably save a couple of days in underwriting on average. A couple other things is don't max out your credit cards. Don't dispute anything on your credit also. So this is mostly credit and the funds that you have. And you wouldn't believe how many times you start a loan process and either there's a large deposit that just came in and you have to back that out of the transaction, or someone's disputed an account, or they've charged up their credit cards. What the lenders are doing now, and it's a Fannie Mae requirement, is 10 days before closing, they're actually doing a soft credit pull to make sure there's no new inquiries on your credit report, so there's no new debt, and they're also checking if the balance have increased, your payments probably increased on your credit card. So that's why it's crucial not to use those credit cards. So if you have someone who's close on the debt ratio, it could affect them. We've had a few where has it been resolved? Pretty much all the time it's been resolved.
What do they have to
But-
pay it down? Is that what ends up happening, or?
Correct. They'd have to pay it down or remove a dispute or just verify that the inquiry was not any new debt that was added. But it could be a delay. It could be a day, 2, 3 days or something like that. But it could be frustrating because the seller may not understand, or it's time to, they need to sell that home for whatever reason it is, you know.
Right. Or, you may have to ask for an extension on the commitment letter. Maybe you can talk a little bit in terms of what you guys actually provide in terms of a commitment, so that the borrower and the real estate agent knows that the loan is going to come through and happen, because if it didn't and you didn't get an extension, their earnest money is at risk.
Well, when you talk about loan commitment, you're talking about like once the underwriter approves the file.
Right.
Okay. Yeah, our process is we actually, when the contract comes in, we get the disclosures prepared, the loan application, and you sign that and you provide that to us, and we order the appraisal at that time. The process time usually takes, 5 to 7 days where the appraisal's coming in, and then the file goes to underwriting. Right now we're at same day, next day approvals, but a normal turn time is about 2 to 3 days in underwriting. And then we get the loan commitment, which is, it's on your contracts, there's a date that you want to hit for loan commitment. And typical conditions on a loan commitment would be, like updated pay stubs, maybe extra explanation on your job because, some people have overtime, or they don't work 40 hours. Just some of those are some of the things that are on there. Did I answer your question? No, I didn't know if you.
Yeah. So it would be important for the real estate agent to give you a call to kind of write, because the contract is 7 days prior to closing. You're supposed to have a commitment, and at that point, the buyer's earnest monies are at risk if they weren't able to close. So we're always concerned that we go beyond that 7 days, and then for some reason they're not able to get the loan, and the seller could scoop their deposit. So.
Okay, well, once the commitment is issued, the borrower gets a copy of that commitment, and the agent
But the
is provided.
commitment could have some conditions.
The commitment could have some conditions. Our commitments are, we have those well before 7 days. I mean, especially with TRID right now too, being ready to close on time. So, I mean, if we have a 30-day process, we close our loans in 30 days or less. So in the 30-day process, you're looking at day 15, and calendar days to have a loan commitment. And if there is an issue, you would know in those first 15 days if there was a problem, and you'd have enough time to prepare the listing agent on, hey, we may need an extension, and here's why. It could be a title issue. It could be a borrower got sick or something, and he's not at work right now. Something like that.
Great. And then when does the clear to close typically come out?
Well, usually when we get the commitment, it takes about 24 to 48 hours to gather any conditions that are needed.
Right.
Some may be third-party conditions like verifications of employment, and some may be borrower conditions. Once that file goes in, across the board, we're at 24 hours to issue that clear to close.
So 24 hours after they've gotten the commitment, provided everything cleared up, you can give them a clear to close.
That is correct.
Yeah.
Once we have all the conditions in, which typically take 24, 48 hours, it'll be an additional 24 to get a clear to close. So next day, basically.
Awesome. So just everybody making sure they understand the clear to close is when you definitely know your client has gotten the loan. There's really, has there ever been a situation where someone didn't get the loan after the clear to close has been issued?
I've never had an issue where someone didn't get the loan after a clear to close. Actually, I'll take that back. Fannie Mae has been in the market selling homes for a while, so I have had a few instances about 2 years ago, 3 years, where the home had to be re-foreclosed on, and that was poor management on the title company, which,
So
at least in Florida, we don't pick them as far as for the buyer.
Right. It was more of a title issue.
There was more of a title issue on that, and
so they could have been protected because it was a title issue.
oh yes, and they
Right.
were definitely protected on that because
Yeah.
the seller, most counties here, the sellers pick the title company.
Right.
So yeah, they were definitely protected. But no, once the lender issues a clear to close, it is we have closed every transaction.
So Lisa, any questions, or Lynn, any questions of Len?
After the clear to close, how many days? Is it a 3-day wait before?
Yes, some companies do it different than this, but we issue the final CD. What's
the CD?
The CD is the closing disclosure. It's one of the TRID changes. Is instead of a TIL and a GFE, you get a loan estimate and a closing disclosure. Once we get the clear to close, the CD is issued, and then there's a 3-day waiting period. But the CD is issued the following day after the clear to close, and then there's a 3-day waiting period. Now, when TRID first came out, I said, why not just issue a CD or a closing disclosure, 10 days before closing? And I thought, man, I'm just the smartest guy in the world, because then I can eliminate the 3 days, right? And I was told, no, we think this is a better process. And this was being our management at our company. And so we did the 3 days. So the final CD was issued. And I had to call them back and say, you guys are doing this the right way, because those closing disclosures that do go out earlier create nothing but the borrower's calling and saying, this isn't correct, because you're just issuing a CD to eliminate the 3 days. We take the approach as, let's just get the loan clear to close early, and the 3 days is not a problem. And it's been very, very helpful to issue that one CD, and it's the final CD. And the borrower's just calling you once. It's kind of like going over the HUD statement one time,
Anybody out on Periscope have any questions for Len? At least anything coming through? Alrighty, well we appreciate everybody tuning in, and so it'll be live on Periscope for the next 24 hours, and then we'll have the video up on YouTube more than likely on Monday, and you can watch it there. Thanks for tuning in.
Thank you. Thank you.